Merci, Catherine. Jenny, pleasure to have you here in Montreal. Great to spend some time with you. I'm going to ask you a few questions on a couple of topics that I think you know something about. Given the current environment that we're in, it's hard not to just talk about the topic of all the changes going on in the world, but rather than asking you where you think the future of the world is, focus on something where you're very knowledgeable, and that's how are investors around the world reacting to the changes that we're all talking about. And I know you know investors around the world. Jenny and I and Franklin and Power have quite a business relationship that we've developed over the last few years. So I have the occasion to talk to Jenny every few weeks. And I think in the last 6 weeks, I called you once, you were in Asia. Then the next time we had to talk, you were in the Middle East. That was like 4 weeks ago. And then last week, you were in 5 countries in Europe. So you are talking to investors all the time. What are they telling you? Are they going to retrench from investing in the United States? Might be the primary question. Are they going to stay invested? What are they telling you? How are they handling all this change?
Well, first of all, it's an honor to be here. So thank you for the invitation. Interesting. I was in Davos, and it was my first time there. And everybody always says, short whatever the topics are in Davos, right? So the topics there were AI. So still at least positive on that. And the second was when people talked around the world, they literally left out Europe as if it wasn't even really relevant to the story. And then, of course, the best performing stock market index so far year to date has been Europe. I think, and you hear it here, there's been a bit of a wake-up call. Obviously, with Trump and the tariffs, the conversation has been, wow, really frustrated. We're allies. Where did this come from? I mean, this is, kind of shocking. But actually, the other side of it, you hear people say, and it was definitely a conversation in Europe of, well, actually, this may be a really important wake-up call for us. And the wake-up call is, and frankly, it's relevant for Canada as well, asking yourself, with the great education systems, the great talent you have in the country, why aren't some of the most interesting big technology innovations of the future, those companies coming out of anywhere but arguably, Silicon Valley, US, and then also in China? And so I think it's been one of those moments where countries are kind of looking at it and saying, this is an opportunity for us to rethink it. In the case of Europe, what was interesting to note, Franklin Templeton has offices in 35 countries. We have clients in 160 countries. Not one of the conversations was about their labor laws, which are issues in a lot of these countries from an opportunity standpoint, but also how the capital markets work, how policy works. But to answer your question, the big, on the institutional mind in places like Europe, the question was more about not the opportunities in the U.S., but a worry about the U.S. dollar. And with obviously where rates go and the deficit, that if you look year to date, the dollar versus the euro is down 9%. So if you have to get over that hurdle plus get the investment returns, there's a real kind of concern. And today, the U.S. accounts for 30% of the world's GDP, and yet it's 65 to 70% of kind of the global market index. So people are looking and say, well, we're over allocated there. Maybe we need to rethink that. And then the question is, okay, where do you put it? And then I would just say, with respect to the Middle East, they're looking at themselves as they love this China-U.S. tension because they view themselves as the great intermediary that will benefit from what will be an ongoing divide in certain areas between the U.S. and China.
It is interesting that with the last 2-3 weeks, the talk of the debt markets and the bond vigilantes, as they're described, finally arising, it's coincided with a pushback that's pretty broad across the United States from business, from the Senate. You're hearing a lot about the size of the deficit. It's actually, perhaps ruined a bromance that everybody was watching over the last little period of time. So it feels like in the U.S., the amount of debt that's leading to the concern on the currency and interest rates there's actually something happening, and there's a pushback that we haven't seen in the last few weeks. So the markets are speaking, I think. I want to pick up on the point you made about a wake-up call. I know certainly in Canada, we have gone in a direction for quite a while where investment has not been made for a number of reasons, barriers to investment, barriers to trade, which the minister mentioned. And it's absolutely been true that while the world that we know has been shocked, a lot of Canadians are going, these are things that we needed to have been talking about for the past 20 years, and all of a sudden we're talking about them and then we're getting them done. So there's always, the glass is half full, always at
That's right.
some point in time.
There's people in the U.S. are saying it's not MAGA, it's mega, make Europe great again, is what the Europeans are saying now.
I think
the same.
A lot of people are picking up on that little phrase, I think, to make a lot of things great about, with Canada, MACA, how would that work? I don't think it works. Let me switch topics a little bit to another one that you would know a lot about, and that is where private markets are going versus public markets. And I want to say Franklin has been a company that, while your roots are in public markets and you still have an overwhelming number of your mandates in public markets, you continued to invest in public markets through Legg Mason. You acquired Putnam from our group a year and a half ago. I don't know of any public market company of your size, $1.5 trillion, $1.6 trillion US in assets. You have made a major push into private assets in the last few years in private credit, Alcentra, Benefit Street, Lexington Partners in private equity, like major push into it. A lot of the dialogue right now is that the private markets are stuck, they're oversaturated, pension funds have too much, they're not able to sell their investments, so fundraising is difficult, and then a lot of criticism about liquidity and valuations. And where are you on that? Have the private markets run their course? How do you think about it? What's the opportunity going forward?
I'm pretty sure if you ask any public CEO whether they'd rather be private, that'll answer your question about whether private markets have run their course. So today we have about $265 billion in private market assets. I think that makes us like the 7th largest. So we do private credit, real estate, secondary private equity, which means we buy from limited partners, pension funds and others, their portfolio when they need liquidity. And we have about $78 billion in that, and then venture capital. Look, I think, so first of all, why is this great proliferation of private markets that came out of the financial crisis in 2008? In particular, kind of this global push for bank capital requirements. Actually, Canada, congratulations, your banks were all very well capitalized, but the rest of the world ran into a lot of issues. And so it changed the regulatory environment. And today, most banks would say, actually, we'll preserve our capital for our biggest clients. Otherwise, the private markets have kind of filled in. So you have this massive growth in private credit, which I don't think reverses. So that's one. Second, literally companies are choosing not to go public if they can avoid it. And there's so much money in the private markets that they're able to avoid it. And so in 2000, that was probably an anomaly, but in 2000, the average company went public after 3 years. Now companies are waiting 10, 11, 12 years to go public. And so, that will not change as long as the sort of costs of being public exist. Not to mention that, I think that the concern with that is public companies have to focus so much on quarterly earnings that there's a hesitation to invest in technology, which you have to be investing in AI and, in our case, blockchain as well if you're in asset management. And yet you won't see the benefits of those earnings for 5+ years. And so if you're a public company, that can be really hard to make those kind of short-term investments. So I think, to answer your question, private markets are here. Now, let's look at private equity. Private equity's cash flows, in other words, the monetization of the investments that they've done are actually half of what they've been. So it's very slow to be able to monetize. Well, in the heyday of private equity, which deployed about $6 trillion, interest rates were essentially zero. So it was a lot easier. You didn't have the cash drag. Now they have a carry cost of 7%, probably 8%. And that's going to make it really difficult if you can't monetize faster. So I think we're going to start to see who's actually a skilled private equity player. Again, in our space, we tend to go buy those. Our Lexington Partners, the average discount on their current fund is buying it at 27% discount from the current mark of the private equity mandate. And then from a growth standpoint, most institutions probably have their full of allocation. That's why there's such a push into the wealth channel to kind of the retail side of this, which I think is where the next phase of growth will be.
So your comment on being a public company and the difficulty in investing and the term that you need to look at investments, you're a family-controlled company, the Johnson family, for Franklin, the Desmarais own Power. But even with a long-term shareholder, it's difficult, right? Because you're putting capital in that doesn't translate into earnings for a long time, and the public markets are very difficult with that. So I share that with you, but there is long-term is the key, would be an observation that I would make. And you're basically saying that's one of the key drivers into private markets, which I can totally see. The short-termism of the public markets are a big challenge.
I mean, I can't tell you the number of times we've spent the last 5 years basically developing, I think, the broadest capabilities in private markets to be able to bring all these capabilities to clients. I can't tell you the number of investment bankers who come in and say, I had a great idea. You should spin that all off and get bigger multiples because your traditional business doesn't trade, and and you get a one-time pop, but you end up not building a good long-term sustainable business. That's not good for anybody. And so that is one of the worries, I think, about the public markets.
So if valuations, the private equity world is stuck and they're having trouble getting out of their investments, rates are up, you're in the secondaries market, as you said, through Lexington, one of the biggest secondary players. That's got to be not a bad place to be at right now. There's a lot of supply that's hung up there. And that's also a great product for individual investors. And where it appears to be turning now is if the pension funds are fully allocated right now, individual investors are not. A lot of debate going on about is that appropriate for them to be in illiquid instruments or not. But if they are going to get in, they're going to get in on a diversified basis, which is one of the things the secondaries bring. So tell me your thoughts about what you mentioned there. What happens with private individuals investing going forward? How do private markets fit into that?
Yeah, I mean, one of the big concerns about this growth in the private markets, over the last decade is you literally left out the majority of investors. Well, one thing that really ticks people off is when it feels like it's not fair, right? And so if it's not fair, if there are excess returns in the private markets, and I, as an individual, don't have access to that, then I'm really annoyed by it. My grandfather got into the mutual fund business because back in the 1930s, the average investor couldn't invest in the stock market. So somebody came up with this innovation around, a mutual fund. Well, this similar thing exists today. But the problem is these are absolutely illiquid assets, right? And so unlike a pension fund, which can project out their cash flow needs for the next 25 years, we as an individual may or may not be able to know exactly. And when we need it because of an emergency, an unexpected emergency, we need to get access. And these are absolutely not liquid assets. So there's a lot of innovation that's happening. Some of the innovation is a combination where you have a traditional product and you combine, let's say fixed income, some private assets in there with public. 401k, I mean, you guys own Empower, which is second largest but fastest growing 401k platform in the U.S. And definitely that's a great way because there's always cash flows going in because people allocate their paycheck into the product. And so I think that the next phase is going to be around innovating the vehicles to responsibly give access. And then I'm a big fan of the financial advisor because oftentimes people don't actually understand the inherent risk of some of these, no matter how much you tell them. And so having an advisor that really knows the client's behavior, do they tend to spend a lot? No, they're really good savers. They're conservative. They live a certain way. These are the risks. And helping that client make those decisions as an advisor. But we absolutely have to give access broadly to these private markets because there are excess returns because of the illiquid premium.
Yeah, I mean, I think you mentioned Empower. I think we think of it the same way, which is that if putting an individual investor into a single alternative fund is probably not a good idea when it is and because they might need liquidity. If they have, first of all, a pocket of their money that's long-term investment, that's where it starts to get appropriate. And putting it in where it's a kind of multi-asset portfolio type approach. So you mentioned the 401k and Empower. Think of the investors there. They're saving, they're working over 40 years. They're saving, they're not using that as a piggy bank to be needing their liquidity when something goes wrong at home or they need some cash. It's long-term money. They don't even look to it. And so having a sleeve of that where you put private equity into or alts into the portfolios is actually, we think it's
secondary PE is a way better way for that.
Secondary is PE, as I said earlier, because it's also
more diversified and they have cash flows that come much earlier.
For sure.
And they have the returns equivalent to, the private equity market.
Yeah, so
Just a
this
little
is right.
commercial.
This is right front page in the last 2 weeks. Has become another political issue, whether they should be doing it or not. And I would agree with you. I can't leave public markets. I want to turn to technology, but I can't leave it quickly. Since the financial crisis, passive has just been a steamroller going right over active management. Active's been in outflows for the last 17, 18 years. Do you see the environment changing for that, or is that still the train that we're on for a while? How do you think about that?
Well, so right now, active is outperforming passive. But look, the way I describe it to people, there's a place for both. If you're an active manager, your job is to provide risk-adjusted returns. And so anytime you get an index, and one of my pet peeves is that nobody talks about market beta and how it changes its risk profile. The day Tesla was added to the S&P 500, it became significantly more risky because of the impact of volatility on that. Volatility is one measurement of risk. So first of all, nobody talks about market beta and where it is in its kind of historical risk profile, but that's an important thing to think about. And active managers in a momentum market where you have a concentration of 7 stocks out of 500 accounting for 35% of the index, that's a concentration risk. And so an active manager is often going to underperform it because they have to weigh in that concentration as one of those. And so I describe it to people. I say, look, if I said to you, buy the cheapest car to get from point A to point B and safely, you'd go out and you'd buy the cheapest car with no safety features. But if you had to drive over a snowy mountain at night, you're going to wish you'd paid up for those safety features. And most people's savings journey is not a straight road that is flat and well paved. And so that's why I say that, there are times where I think it's a combination of active and passive that are important, but people in broad momentum markets, they forget about those other risks. And the problem is if they need their money when those risks hit, it can be really painful.
You use snow because you're in Canada, is that right? That's quite good.
I'm a big skier, so I've done a lot of mountain roads.
We got a little bit of snow up here. You're in California originally, right? That's right. And
Well, I was born in New Jersey, so I used to ski in Vermont.
Okay.
Good ice. That's where you learn to edge.
Okay, you're good. Yeah. Okay, let's switch to technology. Everybody's chatting about AI, and how do you think about that, managing one of the largest asset managers in the world? How do you approach that?
I apologize for those who I told this story to earlier, but I think it's really important. There was an article in the Wall Street Journal that talked about, and this is just to give you an idea of how quickly AI is upon us. So research company that kind of job it is to test the various models. So against ChatGPT's latest, they instructed it, among other things, that it had to be able to be shut down, and so that they could deprogram it. 79% of the time, the LLM model rewrote its code to get around being shut down. So then they went in and they made it explicit. You will be shut down, and we will launch a newer model over here down the road. 7% of the time, it still went in and rewrote the code. And it started to copy a version of itself on other servers and left little notes to tell itself how to deal with it in the future. And then when they fed it fake emails that the lead engineer was having an affair, it started to blackmail the lead engineer that if he shut it down, it would expose his affair. So on the one hand, we are dealing with something that is hard to imagine. On the other hand, if you're running a business and you are not thinking about every part of your business and how this is going to impact it, you're going to be left behind. The investments today were in the picks and shovels. Those were the big returns, the NVIDIAs, the cloud service providers, Amazon's, Google's, others. The future is going to be within individual sectors, those companies that figure out how to adapt this in their organization to either create tremendous efficiency, you have to be both, efficiencies, as well as revenue-generating opportunities. And one other just example that was another kind of light bulb moment for me is I started playing on an application called Replit. Replit uses natural language where you can instruct it to write code. So I was telling it I wanted to show the difference between investing early and the importance of power of compounding. So I typed in a scenario. it then said to me, your application, would you like these variables to change? Would you like the user to be able to change the investment amount, the time of the investment, the frequency of the investment? So it's prompting me on variables. And then it writes in Python, it has 4 different code, it writes the code, generates the application. I can then look at it and say, well, actually, I want you to change it this way. I'd like it to look like this and this. It just made me, and then you can publish it and put it up. It just made me a coder. And so if you think about even just from the talent within your organization, which can be a little scary because many of us are in regulated businesses, that these big old enterprise software is going to become much more like a source of database, and you're going to put in the hands of your people the ability to solve problems by being coders themselves. And so, my first thing, of course, is I say to the guy who runs the technology group, tell me how many people are actually leveraging. What percentage of the code are we writing today that is now done by AI? But more importantly, it's going to be, and that's where we do training on how to think about AI, because the future innovation, you're going to be able to put it in your employees' hands. And you're going to have to figure out how to regulate and control it to some extent. But anyway, on the AI front, I'm also incredibly bullish on this. If you look in history, in 1899, the guy who ran the U.S. Patent Office wrote a memo that everything that has ever been, everything that will be invented has been invented, so the Patent Office should shut down. In 1997, Business Week had the cover of it said the death of the broker. The internet was going to destroy all financial advisors. And all that has happened is these things have become tools. Google has 300,000 employees, right? And so I do think that AI, that human nature historically, despite that every time we have a big industrial revolution and predict that all the jobs are going away, we somehow figure out how to leverage this as a tool. So I'm optimistic from that standpoint, but I do think any companies that aren't, figuring out how to leverage this are going to be left behind.
And are you doing that centrally driven, or are you kind of doing skunk works across Franklin and all your offices? How do you manage that one?
So we do have a head of AI who's just particularly good at it, and I've tested him. I knew that I was in good shape when the CFO of ChatGPT asked for a meeting with me to ask for an introduction to him. So I was like, okay, that's a good sign. So then what we do is we kind of think about it in 4 buckets. So obviously on the cost saving side, on the technology side, those are the obvious kind of operational efficiency. And then on distribution and then investments. And on distribution, here's an example. We have a partnership with Microsoft where they are literally, because the idea they said was such an interesting technical problem that they're giving us free resources to build it. And so it's a simple problem with a hard technical solution. The simple problem is, how do you maximize the efficiency of an interaction from a salesperson as they go out to meet with, say, a financial advisor? So very easy, simple. Okay, so now it goes into your CRM system and it looks through and it says, okay, these are the best opportunities that we're seeing from here. It may go out to different product systems. It goes through your own product system. It says, these are the things that you should talk to the client about. Maybe it goes out to social media and it says, you should bring up this because it's important to speak to that client about these things. They're passionate about this. And then you have an agentic AI component. Agentic AI gives permission to the algorithm itself to go out and figure out some things on its own. So it then comes back and says, what do you think? Is this important? And you train it, yes or no. That is actually a technically difficult problem, but just imagine the efficiency that you have if every one of your sales meetings becomes just that much more effective. And then on the investment side, we're doing a couple of things. So our head of our global equity team came from a technology background, so he's very passionate about this. So we've identified champions within all the investment groups who are passionate to participate. They have a group together that are working on it and sharing ideas. And then we're doing like pilots within those. And then we're actually going to run a independent AI investment team. My instinct is not to go out and sell, but my instinct is just like you remember Go and chess, right, beat the masters, but when you added the human with the AI, that succeeded over just AI alone. And so we think on an investment side, it's important to still have the human there with some direction. But the way the AI played chess, the way the AI played Go was different from the way humans had ever thought about doing it. And so by creating this group, we think we may get some things that we learned from it.
Okay, last question. We talked about long-term, and we talked about family-controlled, two family-controlled companies. Where you get faced with challenges, we all do every day. You're always putting out fires, chasing opportunities. When you step out and you look out 5 years, 10 years, and you think about what were the things that I should have really focused on, the one or two key things that you try and anchor yourself in when you're making decisions and you're really choosing your priorities, what do you think about? What are those for you?
I mean, look, I think the most important decision any leader makes is the people they surround themselves with. There's no question about that. And, the challenge is, and Jeff, I know you know this, that sometimes somebody's right for that moment, but the job changes because the environment changes or others, and they've been a great, loyal person, and you have to figure out how to make some of those changes. And that's to me, is one of the hardest things to do, and we all probably take longer to do it. And my father has a saying, he always says, you either are a tough boss or you work for a tough boss, because if you're not willing to make the tough decisions, you're not going to end up in that job for very long. On the other hand, you can be a tough boss and be compassionate. So you try to do it right. But I always think the number one most important decisions for any leader is the people that they surround themselves with. And then, as you know, picking great partners to do business with. I always say, if you have to go back and scour through the contract to figure out whether you have an edge, you already lost.
Yeah, I guess you could say you can buy capital, you can buy machines, but people and culture at the end of the day are the only things that are really differentiating, and that's not surprised that you answered the question, because I know you pretty well, and I know that's the way you think. So Jenny, again, I want to finish where we started. Thank you so much. Jenny, I called her last night on a question. Of course, you were overseas. It was 9 o'clock at night, and she was still on a plane coming in from Europe. Thank you so much for making the effort to be with us here today. Really, really appreciate it.
It's a great pleasure to be here. Thank you. Thank you.
Thank you.